Okay, so like I was saying, yeah, I've explained why you need to trade Forex, the transparency, the leverage. If you have any question, just drop it in the WhatsApp group. We will chat on those questions, okay? We'll chat on those questions. Yeah. So now let's look at the brief history to the financial market. Okay. The evolutions. Money was not this naira that you're seeing here. This paper you're seeing here, this is paper money. This naira you're seeing is not the first money that was invented. Okay. There were different form of exchanges even before money was created. Okay. There were different forms of exchanges. Okay. We had the barter system where people will bring their goods and or chicken. If it's me that was there during that time, I will not agree because why the hell will I want to will I want to eat chicken and then you tell me to bring goods?
Let me stand up.
So yeah, those are different forms of exchanges that were being used in place to exchange goods and services. Okay, before the traditional money came in place. Okay, so I believe this is not your first time hearing about the barter system. Um, you must have come across it in previous histories. Okay, you must have come across it in previous history, even during basic history in school, in secondary school, and stuff like that. Okay, so it's nothing new. All right, it's nothing new. So now the evolution of currency from bartering to modern forex trading. In this section, we'll take a fascinating journey through the history of currency exchange. It's intriguing. It's in, it's intriguing to see how the concept of money and trading has evolved over time, leading to the development of the modern forex market. I will bite. Who's that? Mr. Zach, Mr. Abdul Zakau. I'm gonna bite you. All right, so now currency exchange has a long history rooted in the need for people to trade goods and services. In ancient time, people relied on a system called bartering, where they exchange one item for another using a standardized medium of exchange. For example, you might have traded your crop for someone else's livestock or two, just like I said a few minutes ago. Yeah, so uh, as societies grew more complex, bartering became more cumbersome. Okay, so the more people actually got involved in society, the more people wanted to exchange one thing for another. The bartering system became so complicated that people became wise. Okay, let me use that word. People became wise, and then it will be so unfair to me that I will bring two tuber of yam and then I want to come and collect your goods. Okay, so even if you in this present day you will not agree that I bring two tuber of yam to collect your goods. Okay, so these are things that were actually the problem in those days. Okay, so people began using commodities with intrinsic value such as precious metal like gold, silver, and as medium of exchanges. Okay, this metal were accepted by various civilizations and served as a precursor to modern trading. Okay, so now they decided to devise a means. Okay, they decided to devise a means and say, okay, how can we balance this whole exchange of a thing? Okay, I'm in need of a cow. How can I balance a cow? So now they had to take all those things into consideration, because if we are using, okay, bring 10 tuber of yam and come and collect my cow, me, I will not agree. Okay, so now they had to bring out precious metals like gold, silver. Okay, so now gold were being weighed based on ounces. Okay, even till today, gold is being traded in the market. Okay, but they are being traded as commodities. Okay, so even silvers are being traded as commodities also. All right, so they had to start using precious metals. Okay, you have gold, they'll give an exchange rate for gold. Okay, they'll give an exchange rate for gold, maybe 1 ounce of gold or one bag. I don't know if most of you must have seen all these old movies, all these old Persian movies, like the likes of which movie like we use, all these old movies like the Lords of the Rings, those old movies. Okay, even now, funny enough, do you know that Forex was actually ongoing in the Bible, where this person had to betray Jesus for how many pieces of silver? So a whole Jesus Christ, these people exchanged Jesus Christ for 30 pieces of silver. So you understand that Forex trading has been way, way long, even before we can even think about it. Okay, even in the Bible, Forex trading was even mentioned in, I think it should be in Deuteronomy or Ecclesiastics or so. I just have to refresh my memory on that. Okay, so these are things that were invoked in those times. Okay, so people had to use precious metal. If you do certain things, your reward may be a waist bag of silver. Okay, they had their own measurement tool for those things. Okay, so now what you had to do is that you had to sell your cow to somebody that has gold. Okay, the person now will buy from you, and then you can carry that your gold and then go to somebody you want to buy yam from. So they will have to weigh that your commodity you are bringing in exchange for this amount of silver. Okay, so these are things that were ongoing before the present day money came. Okay, so now we had the Brexit Wood system. Okay, after World War II, representatives from different countries met in Brexit Wood, okay, New Hemisphere, to establish a new international monetary system. The system fixed exchange rate against the US dollar. Okay, now let me quickly tell you something now. The US dollar is, we call it the kingpin currency. Okay, this kingpin currency is what backs certain country currency. Now, Naira is backed up by the US dollar. Okay, any small thing here in Nigeria now, madam, wetin sup? This price of this thing don't go up. You say na dollar now. Any little thing na dollar now. Any little thing na dollar now. Why? Meanwhile, we are not using the dollar as a means of exchange here. We are using the naira. But what is actually causing it? The backup currency is actually at a high price. Okay, so that is what is actually affecting the face value currency, which is the naira, in the present day today. Okay, so now the Brexit wood currency are leading to a shift towards floating exchange rate. If you can remember, during the time that Tinubu came in, after promising us a cup of a down payment for a roasted corn, he actually told us that he's actually going to float the naira. Okay, what this simply means is that he's actually going to give access to other country currency to exchange with easy flow. So you can easily buy naira and sell naira easily. Okay, but what we are seeing today is the reverse, is the opposite. Okay, let God just help us, honestly. Okay, so currency begins to fluctuate based on supply and demand. Okay, so if people are in need of a particular country currency, the demand increases. Okay, basic economic principles. Okay, this will lead us back to basic economic principle. Those of us that went to school in SS1, where they were teaching basic introduction to economics, where they will teach you supply and demand, where we have the demand curve, we have the supply curve, where when supply increases, demand reduces, and then when demand increases, supply reduces and stuff like that. Okay, so these are curves that are still guiding the framework of exchange till this present day. Okay, if you, for instance, now those of us that has a skill, okay, like people that are into fashion designing, people that are into home decoration and stuff like that, the more people are in demand for your skill, the more customer, like now, why do you think tailor used to have pride during Christmas and festive period? Why? Because they are of high demand. Okay, so now the basic economic principle of demand and supply is what governs our present day exchange. Okay, so now the next thing we have is technological advances and online trading. Now we had the invent of what? Telephones, we had the invent of computer, we had the invent of so many electronic devices. Okay, and now this actually made the interest or the interest of exchange more seamlessly. Okay, people began to exchange online using online platform. Okay, making it possible for individuals to participate in the forex market from the comfort of our home, which is what we are currently enjoying. There are sometimes I just wake up, I look at the charts, I take my trade even before I brush my teeth, even before I leave my bed. Okay, sometimes I make profit. Okay, sometimes I also lose. And then when you when I lose also, I still sit back and look for another opportunity. And then when the trade is in a good place, or when I feel okay, I'm done for the day, if I've lost enough, I'll just stand up from my bed and go and do other things. Okay, sometimes I may even trade and I may make profit. I'll just be people people will not even know that okay, this person has even done 2x of whatever he risked. Okay, so this is the ease that comes from what? Forex trading. Okay, and now these are certain things that most people enjoy from the comfort of their home. Okay, and now you too also as forex participants, okay, these are things you will also enjoy. Okay, you don't have to go to the bank to exchange. No. Okay, so you can do it from the comfort of your home and enjoy the benefit of online trading. Okay, so globalization and interconnected financial markets. Okay, the US market is connected to the Nigerian market, so it's connected to the England market, so it's connected to the Sydney market, so it's connected to the Japanese market, and so on and so forth. Okay, so this interconnection makes it very easy for the inflow of what? Currency exchange. Okay, participants all around the world enjoy high speed interconnection to the forex market, so you can buy and sell from the click of a button. Okay, so all these things came as a result of what? Internet connection, technology. Okay, so now there are major players in the forex market. We have the central bank, we have commercial bank, we have institutional investors, we have retail traders, we have brokers and market makers. Okay, so these central banks, you know what central banks are? We have Central Bank of Nigeria. Central Bank of Nigeria are the guardians of monetary policy. Anything the central bank, if central bank says A is A, today if the central bank governor wakes up now today and say Naira, we are going to make sure that the Naira goes back to 700, and the economy struggles and tries to make that thing possible, it's going to be possible. Okay, any policy that the central bank makes today affects the Naira knowingly or unknowingly. Okay, what we are currently seeing today is as a result of policies that were made from previous central bank governors. Okay, the likes of Emefiele, Soludo, and so many governors even before this present man. Okay, so now the whole effect, the whole policies that were being made is what we are enjoying in our present day. Okay, for you, you may see it as suffer, but is still enjoying. Okay, so so the central bank plays a vital role in the exchange, in the foreign exchange market. Okay, so representing the monetary policy authority for a country or a group of countries. Their primary objective is to maintain price stability and support economic growth. Okay, the central bank have the power to influence currency value through various tools such as interest rates. This interest rate decision, who is that? Please mute yourself, please. If you are just joining us, we had the first section. The recording will be available on YouTube by the grace of God by tomorrow. Yeah. So, where did I stop? Okay, so the interest rates and intervention in the foreign exchange market. Okay, understanding their actions and policies is crucial for forex traders. Okay, that's why we will also look into what? Different type of analysis, where we look at fundamental analysis. This is where what? We are actually in communication with what? The central bank and then the big players in the market. Okay, so this will also look into this in subsequent section. Okay, so now we have the commercial bank. Okay, so they facilitate the global transaction. If you want to exchange, if you want to buy dollar now, you will not carry yourself and go to central bank. They even give you slap for there. Trust me. Okay, if you want to buy $100, you want to sell $100, you will not carry it and go to central bank. You carry it and go to your local bank, is UBA or Keystone Bank, whatsoever. Okay, we also have Burundi change. Okay, we have Burundi change. These people that exchange currency. All of us, each and every one of us involved in the forex market. Okay, but theirs may be slightly different. Okay, so these people, their levels to their hierarchy. Okay, they get from central bank. Please mute yourself. They get from central bank at a particular rate and then resell to what other people. Okay, now the commercial bank can get uh rates from the central bank. Okay, now this commercial bank now can still give rates to what the Burundi change people. Okay, which are institutional investors. Okay, now these investors now, if we have direct access to the investors, they can also give us rates with the retail traders. Okay, but now one thing you need to understand is that the brokers has actually made it possible that we can actually get the rates directly from the central bank. Okay, or directly from the commercial bank. Okay, so but majorly it's from the central bank because it is the central bank that regulates the rates. Okay, and the monetary policy. All right, so any rate that is coming to a particular country comes directly from the central bank. UBA cannot decide how much is going to sell dollar to us. UBA cannot decide. Is if the central bank decides sell dollar at 110 naira per dollar, UBA will have to sell within that range, but they will have to put in their own little pence so that they can see their own interest or profit from the arbitrage. Okay, the difference between the buying and selling price. Okay, so these are ways people make money in the forex market. Okay, the banks may not really be doing the way we're actually doing it. Okay, but they are still involving in the forex market. Okay, so let's go down to like I said, this note is actually going to be available for you. You can just read through them and then try to understand them in your own way, in your own words. Okay, don't use the words that are written here because over time you'll forget about it. Okay, try as much as possible to break them down so that you can digest it. Okay, because if you don't digest it, it doesn't really make sense to you, and anything that doesn't make sense to you, you cannot defend it. Okay, so forex terminologies. Okay, so and now we have what exchange rate. Okay, now these terminologies are the essential terminology used in the forex market. Understanding these terms is crucial for navigating the world of forex trading. So now we have what exchange rate. Now, when someone tells you exchange rate, it's very simple. Exchange rate, rate at which something is being exchanged at. Shikena, that's all. Okay, it's simply what the value of the currency. What is the currency currently valued at? Is the country currency valued at 1 naira per dollar? Is it currently valued at 10 naira per dollar? Is it currently valued at 50 naira per dollar on the exchange? Okay, that is what it simply means. Okay, exchange rate. Okay, now we have what lot size. Okay, now a lot size is actually a size or is actually a trading volume. Okay, now you want to say, okay, I have $10 I want to risk. Okay, you have to, there are some mathematical complications where we also have to break things down. Okay, but let me just quickly look into this. Okay, so now lot size refers to the standardized quantity of a currency that is traded in the forex market. Okay, it represents the volume of currency units in a transaction. Lot size varies, with the most common being standard lots, mini lots, and micro lots. Understanding lot size is important for managing risk and determining position sizing in forex trading. Okay, so now we have the standard lot. The standard lot is one, okay, 1 unit, okay, and now the standard lot has a contract size of 100,000, okay, which is, for you to properly understand this, we have to do what? Link them up, okay, which we'll also be doing it. Okay, so let me bring out a fresh page. Okay, the standard is 100,000 units of contract. Okay, what this simply means is that when you're buying, when you open a one standard, what you are trading behind the scene is 100,000 units of contract. Okay, and then when you're trading a mini lot, okay, mini, then micro. Mini is 0.10, micro, okay, 0.01. Might mix this up, but I will still differentiate it. Okay, then a standard lot is one. Okay, one, mini, micro, and then this mini lot is 10,000 unit of contracts. Okay, and then this micro lot is 1,000 units of contract. Okay, what this simply means is if you open a one standard lot, what you are opening behind the scene is 100,000 units. Okay, you have access to 100,000 of that particular contract. Okay, if you're opening a mini lot, you have access to 10,000 units of contract. If you open a micro lot, you have 1,000 units of contract. Okay, so all these things, the calculation, we have to merge them with what position sizing. Okay, so everything has to make sense. Okay, for you to get your lot size in trading, you need to know what you are willing to risk. Okay, minus what your stop loss value. Okay, let's say for instance now you are risking $10. Okay, and now this trade is, or let's say you are risking $100. Okay, that's what you want to risk. Oh, well, at the end of the day, some of us will not want to risk. We still want to risk $100, but once you see the market is going against us small, we have closed. Okay, so but which is not a very good and healthy way of trading. If you want to risk $100, stick to it till the very end. Set and forget. Put your stop loss, put your take profit. Meow, disappear. Okay, so you want to risk $100. Your stop loss value is about 20 pips. Okay, so the whole calculation here, their position size calculation we use for this particular lot size here. Okay, so this is the position size calculation, and then you can see it here. This is the unit of contract, this is the sizing. Okay, and then this is the money dollar equivalent. Okay, so let's say we're using USD, Euro USD. Then we have our account size of, let's say we have $10,000. Okay, and then we want to risk 1% of $10,000, or let's say we want to risk in money value $100. Okay, and then our stop loss is what did we say our stop loss is? Our stop loss is about 20 pips. Okay, and the lot size, just leave it at 1. You just have to calculate it here. So now this is, the unit is about 50,000 units of contract. Remember, the sizing is 0.05 lots. Remember what I said here, mini is 0.01. So now since it's a 50,000 unit of contract, it's actually 0.05. So it is still within what? The mini range. Okay, it's still within the mini range. All right, so this is how you get your position sizing. Okay, so we will still discuss about this in subsequent class. I just felt I should just give a quick insight to it. Okay, so now that this lot size here, this 0.05 is my lot size. Okay, is this trading in volume? Okay, is this trading in volume? And what I have at the back end, I have access to what? 50,000 units of contract. Okay, so now we have what? The bid and ask price. Okay, now I know most of us here know how to price. Okay, especially there are some people that they call perempe. Okay, so there are some people that they know how to price to the extent that if you leave them, they will even price their own bride price. Okay, so they can price for Africa. All right, so they in the forex market they have given you the opportunity to price. Okay, you can price in the forex market. Okay, now the asking price, or the price at which you are going to buy from, is actually your bid price. Okay, you are bidding to buy at this particular price. Okay, now this is the price at which the market is actually offering you. Okay, this is the price at which the market is actually offering you. Okay, you're actually asking and then you are bidding. Okay, buying and selling, ask the price at which you are willing to buy, and then the price at which the market is going to fulfill your order. Okay, so in the forex market there are two prices for each currency pair: the bid price and the ask price. The bid price represents the highest price a buyer is willing to pay for a currency. Remember, is willing to pay. A keynote is willing to pay for a currency. While the ask price is represent the lowest price a seller is willing to accept. Do you understand me? So now you are bidding, you are asking. Okay, this is the price. I want to buy a particular cloth at $1,500. Okay, I will tell you, madam, you no go sell for me for $1,000. You say no, ma. I will sell for you for 1,000. You say no, how much last? Okay, all this whole process is what you are bidding. This is the price, at least this is the highest price you are willing to pay for that particular clothes. You understand me? This is the when there's some, I don't know why, yeah, but forex traders should be one of the crazy set of people when it comes to pricing of commodities outside. Okay, you can go outside, something that is being sold for 1,000, you can price it down to 500. In fact, the whole forex trade, African mothers should be forex traders by default, because by the time they price your market, even you self, you will have to go and ask the person that sold to you that why did you sell to me at this price when this woman is actually asking for the stuff at this price. Okay, so the price at which you are willing to offer is your bid price, and then the price at which the seller is willing to accept is what? The ask price. Okay, so that is just the whole thing. So now the difference between the bid price and the ask price is known as what? Spread. Okay, is known as spread. Traders need to be aware of the bid and ask to execute trade efficiently. Okay, so now this spread, okay, is where your broker make profits. All this small stuff, that's where some brokers make profit from. Okay, so now, like I said, spread here is a transactional cost. Okay, it's not for you. You cannot eat your spread. You cannot eat your spread and have it back. Okay, so spread refers to the difference between the bid price and ask price. Remember, bid price is the highest price at which you, the buyer, is willing to buy. Okay, and then the ask price is at the highest or the lowest price at which the seller is willing to take or to accept your offer. Because for a transaction to actually be fulfilled, buyers and sellers has to come to an agreement that, okay, no problem, I agree, I buy them for this price, okay? You go say no, oga, you no go sell for this price. Say no, buy them for this. So these are things that we do in the forex market. Okay, our day-to-day life happens on the forex market even without us seeing it like plainly. Okay, so it represents the transactional cost incurred when entering a trade. A spread can be fixed or variable depending on the market condition. Okay, now there are some times where spread is very wide. Okay, during Asian section, spread can be very crazy. Okay, we are running out of time, so I have to be very fast. Okay, so let's see, man, I wish I can extend this. What's the time? This is 8:20. If you want us to do one more 40-minute section, just drop 111 in the chat section. Let's see if we can finish this up. Okay, just drop 111 in chat section, and then let's see if we can finish this up with one more section. And let's see if we can finish today's section. So yeah, so all right. It represents the transactional cost incurred when entering a trade. Spread can be fixed or variable, depending on the market condition and the broker. Okay, tight spread is generally preferred by traders as they result in lower transactional cost. Okay, everybody wants tight spread. There are some broker that offer zero spread. There are broker that offer very, very tight spread. Okay, like Xness, they have varieties of uh accounts to choose from. Okay, you can choose a standard account, you can choose a pro, you can choose a zero spread account. Okay, so you just have to choose what works for you. Okay, so now we have the bulls and bears. Okay, these are terminologies used in the forex market. Bulls and bears. When somebody tell you, man, I'm bullish on this market, it simply means I'm buying the market to stupor. Okay, or the buyers are in control of the market. And when they tell you that the bears are in control of the market, it simply means the sellers are in control of the market. Now, how did they get this analogy? Okay, how did they get to come to a conclusion that we are going to use bulls and bears rather than chicken and turkey? Okay, instead of them using chicken and turkey, they decided to use bulls and bears. Reason because when the bulls are actually fighting, they throw the the their opponent up. Okay, they use their horn and then they fling the opponent to the upside. And then when bears are actually fighting, they pounce on the person, like the person is actually come down and then they pounce on the person. Okay, so these are situations that actually um uh led to the whole bulls and bears scenario. Okay, so bulls and bears are terms used to describe market sentiment in forex trading. Bulls are optimistic traders who believe price will rise, while bears are pessimistic traders who expect price to fall. Okay, understanding market sentiment is important as it influences trading strategies and decision-making process. Okay, so it's a very simple stuff. Okay, so PEEP. Okay, PEEP simply means measuring price movement, okay, or price interest points or percentage in points. Okay, so PIP stand for percentage in points, price interest point. It represents the smallest incremental movement in currency pairs price. Okay, so now let me quickly show you this. Now if you look to my right hand side, if you look here, okay, you will see certain numbers. Okay, now this number, let me just take one for example, 1.30800. Okay, now all these numbers, they move. Okay, they move depend on, you can see we have 1.282924 here, we have 1.3320. All these things are different price quotes. Okay, and now they move. Okay, how do they move? They move due to the change in price. So the moment this one changes from 1.3180 to 1.31801, okay, it can be clearly seen that the market has moved by what? 1 pipet. Okay, now a pip is the fourth decimal point, is the fourth number after the decimal point. So this is the decimal point here. We have 1, 2, 3, 4. So this fourth number here is the pip. Okay, and now the fifth number after the decimal point is a pipet. Okay, now this mostly occurs during what? The US dollar cross or quote pairs. Okay, this mostly occurs during the US dollar cross or quote pairs. What do I mean by US dollar cross or quote pairs? Any pair that has US dollar behind it, either in front or behind. Okay, this is GBP US dollars. Okay, we have USD CHF. Okay, I'll also be giving you guys assignments. So yeah, and then so I will truly understand that you guys are following. Okay, so this is USD CHF, okay, which is the US dollar against the Swiss franc. Okay, so now in the USD CHF price quotes, we have 0.90787. Okay, now what this simply means is that for $1, Okay, for $1, you have to pay what? Zero $0.90. Okay, and then for $1, when it comes to the GBP USD, oh no, this is GBP USD. So for $1, okay, sorry, that was USD CHF. So for one Swiss franc, okay, for one Swiss franc, okay, for one Swiss franc, you have to pay $0.98. Okay, that's what you have to pay in order to get one Swiss franc, okay, which is one CHF. Okay, and then for you to get £1, you have to pay $1.38. Okay, so that's it. All right, so let's quickly look into this, and then before we have our time running out, let's see how many people say they want to join. Okay, we can just quickly do one more section, and then we'll call it a night. Okay, I would like that we stick to our guidelines. Okay, so we can quickly finish up. We are somewhere around here. Okay, we'll try as much as possible to rush through. Okay, so yeah, let's quickly look at market orders. Okay, so we've looked at PEEP. We'll also be explaining this in details, possibly tomorrow. Tomorrow is Saturday. We may have more like a more extensive time. Okay, so PEEP, like I explained, percentage in price or price interest points. Okay, leverage and margins. Okay, leverage allows traders to control larger position in the market with smaller amounts of capital. Okay, like I explained earlier, it magnifies both potential profit and loss. Margin refers to the portion or of funds required by a broker to open and maintain a leveraged position. Okay, so for you to actually leverage, you need a particular amount. It's just like a deposit to collect loan. Okay, that's just what this whole leverage and margin simply means. Like I explained, leverage you can use 1:100 leverage, which simply means that for you to open a position worth of $100, the minimum you need to deposit is $1. Okay, that's just what it simply means. Okay, so the margin is the money you need to deposit in order for you to achieve or get a leverage. Okay, so if you have any question, just drop it on our WhatsApp platform. I will attend to those questions personally. Okay, so now we have different type of orders. Okay, we have different type of orders. We have let us explore the different type of order used in the forex trading. Those orders allow traders to execute trades and manage their position effectively. Understanding this type of order is essential for executing trade with precision and control. Okay, so we have market order, which simply means you are buying at immediate execution of the trade. Okay, ensures immediate execution. So the moment you open a trade, bam, in market order, you bought at market price. Okay, so limit order, you're expecting price to come back to a particular level above, and then you enter at a discounted price. Okay, stop loss order, stop entry order. A stop entry order is an instruction to buy or sell a currency at a future price. Okay, so price will have to come to that place. Okay, but this limit order, the difference here is that this limit order, price will have to come back, okay, to pick you up. Okay, but this stop entry order, price is as if price is going, then you just join in. Okay, but this one, price will have to come back, will have to retrace for you to join.